Nkonki has the professional capacity to deliver on your external and internal audit assurance requirements. Visit nkonki.com for more.
Welcome back. We're talking about the role of investors in responsible business with our guests, Sitolele Cindy and Adrian Bertrand. Now, Adrian, this is for you. Pension funds have a long-term investment horizon, as Mervyn was saying in the previous section. But yet, the average holding period of pension funds in the US, I think the latest stat is less than a year.
I think we're seeing high-frequency trading by service providers to institutional investors. A lot of this is done electronically. If I use the example of the GPF, even though our shareholding may change from time to time, we are still a long-term shareholder and will be invested in that company much longer than the board and the management of that particular company. And so, yes, the average holding period for shareholders may be reducing, but it doesn't do away with your responsibility as a long-term responsible investor.
And it doesn't detract from taking a longer-term view of the company when you decide to invest in it.
No, that's true. Just to share with you, as an investor, it takes us about 9 months to finally get management to agree to engage with us, and then we conduct ESG research into their, as a responsible business, to see how responsible a business they are. It takes us 9 months. In other instances, it took us 2 years, some of the big corporates in the country. So the point I'm making is that we still hold that long-term view. We only hope that the process of engagement could be shortened, so then we can come to decisions sooner.
So we often talk about responsible investing, and those are investment funds that invest to a certain responsible mandate. But really, isn't all of this just common sense investing? I mean, you have to, if you're a business in Gauteng, think of the lack of fresh water going forward. So that's not responsible investing, it's just common sense investing.
Well, I always say, Leigh, that reality is a driver here. And the reality is that we are sitting in a world where the demand for product is increasing, and we've got finite natural assets which are decreasing and being used faster than nature is regenerating them. So in that context, not to do the kind of exercise we've been discussing would actually be a failure of duty by the trustees of a pension fund. Because then they might be investing in a company that hasn't got its mind focused on a natural asset which may be like water, which is absolutely critical. But not only that, unless you do these exercises, you could have a big asset on your balance sheet. And because of natural and social capital, for example, the cost of energy climbing, peak oil, you could end up with plant and machinery, the biggest asset in your balance sheet, becoming a stranded asset in 7 years' time.
So if directors don't consider these things,
absolutely,
could they be held personally, legally liable?
Absolutely, because if that stranded asset disappears and the company loses, I don't know, 1/3 or whatever it is of its market cap, because suddenly you've got a stranded asset on your board, on your balance sheet. And a board has never, as the minutes of the board meetings will show, never applied its mind to this. I think they're absolutely liable to the duty of care to the company in damages.
Okay, I want to move on to integrated reporting. Integrated reporting among listed companies in South Africa, we've been doing it for 4 years, and we're acknowledged as leaders in the world in this space. But has it changed the way you make your investment decisions when you read a company's integrated report?
To a lesser extent, it has helped to change, but I guess the important thing is what is in there in the integrated reporting. You find a lot of companies, actually it's a patchwork kind of a thing. They'll take something from the sustainability, because there's another silo approach with companies. There'll be a sustainability committee, there'll be another committee which is basically looking at something within the company, health and safety may be one of them. Then the patchwork, they add those 2 or 3 committees work together, and then they say it's integrated reporting. But what then gets lost out is materiality of what is there in the integrated reporting. But there's improvement. Some companies have written very good integrated reports which help us.
Like whom?
You want me to mention their names?
Well, we can think of, I mean, there's some winners which seem to win all the awards.
Well, they are mixed. They are mixed bag. I mean, the most recent we've gone through, it's a small company, Hubert Davis company.
Yeah.
Their integrated report, sustainability report, was very good. I mean, as we're looking through their reporting as investors, quite a lot of information was there. You didn't have to go dig deep. Whereas with others, you have to go through them, go through probably 4 or 5 reporting agencies to try and get information about what they're doing.
So an integrated report should make your life easier, has it?
I think it has. You know, certainly to Zituleli's point, there's a lot of companies that are putting a lot of effort into the way they report and what they're reporting on in their integrated reports. Again, I think we'll discuss it a bit later on today, but you know, the importance of integrated thinking, and the integrated report is there to give evidence of integrated thinking happening within a company, both at, you know, management level and at the board level. And what I would like to see more of is, or to hear more about, is the role of the board in their signing off of integrated reports.
Mervyn, the role of the board in signing off?
Well, the board doesn't have to sign off because it's naturalia, a legal term, that once your integrated report comes out, it is the board's report. They have responsibility for it, whether they like it or not. And whether they sign it or not is legally irrelevant. So it is their report. But on the question of materiality, in the IRC framework, we talk about significant impact. That which has significant impact is material. But companies are being guided more and more by learning about the legitimate and reasonable needs, interests and expectations of their stakeholders, because that's informing management. But it's also, and the board should have an agenda item, stakeholder relationships at each board meeting. So at the end of the year, these needs, interests and expectations actually guide a board on what is material to report. And the question is, the report, we say, must be transparent. By that we don't mean naked. We mean a balanced report. You know, there's a natural human inclination to highlight the positives and downplay the negatives. We want a balanced report. That must be a balanced report. So when Adrian reads it, he's reading a balanced report, warts and all, the positives and the negatives, and he can make an informed assessment about that company.
But how widely read are integrated reports? You two are enlightened investors. Amongst your colleagues, who reads integrated reports?
Well, it's the researchers.
Are they widely read, Zituleli?
Well, okay, in our case, it's the researchers because they have to produce a report which is going to help us to make informed decisions about investing in a particular company. So it's likely read by those. But I guess what Prof. King was making, a point was making, that there needs to be a lot of stakeholder investment involved, stakeholder interest being taken into account when it comes to integrated reporting. The point I made earlier on, you find that it's a silo kind of approach. What Adrian was raising is that the board needs to sign off by showing that the point we're making, that there needs to be a stakeholder relationship item on every board meeting. That will help them, that they sign off, they understand. Because some boards, not most boards, some boards, it's Leigh's work to produce that fuddy-duddy sustainability report. That's what that's a kind of the directors sit there, they say, oh yeah, okay, it's one of those things. But our concern is more the bottom line, how we pay back the investors. But pay back the investors fairly and responsibly, because then you need to be able to look at the 3 P's: people, planet, profits. That's the balanced approach that we would want to see. So,
and that's a broader outlook, and that's taking a longer term view. Adrian, when you interrogate companies on what's in their integrated reports, I mean, first of all, do you just accept this is a good read? Do you ever go back
well,
and say,
we hope it's a good read. It makes it easier, especially when it's 200 pages. But no, we do review all of our investee company integrated reports, any reports that they're producing, and we use that in our engagements with the company. So if a company is not producing an integrated report, we certainly want to know why not. In some circumstances, that's excusable. If it's a small cap company, etc., they don't have the resources. But really, if you're wanting to grow, if you're wanting to attract mainstream capital, you need to be providing as much information as you can.
How closely do you look at the material matters disclosed in that integrated report? A company usually has 5 to 10.
very closely, because we want to monitor and measure management in how they are addressing those material risks. Those are the risks that the company is putting forward for investors to be aware of, and it's about how they manage that over the short, medium and long term.
In integrated thinking, it's the latest business buzzword. It's where a company manages the 6 capitals, not only financial. Do investors like that idea?
Well, they do, but let's show that what I would call the norm, or the established kind of investor or asset manager or benefit or asset consultant has got a different outlook. It's a question of saying, let's see performance of this company, of these shares, and so on. The issue of looking into social and environmental and governance issues, it's something that's taken, or it's a nice to have for some of them. So that's another battle where we need to go in and move and influence, gently persuade the other management, the boards, to look at the thing in a holistic way. We always say that integrated reporting or sustainable reporting should be the DNA of every company. And by DNA we mean that it must cascade from the chairman of the board right up there down to the lowest stakeholder who sweeps the floor of that company. That's the kind of
embedded
thing.
into the company. You like integrated thinking, Adrian?
I do like integrated thinking. I would hope that it's been happening at company level and at investor level for a long time. But I think it's really just clarifying what does it mean to think, truly in an integrated way. And, it means considering the broader capitals, not just financial capital. And I think it's early days yet. We will get to the point where your pension fund boards of trustees will be asking their service providers about other capitals, not just financial capitals. That's a work in progress, and again it'll be interesting to see how investors would respond to pension fund clients around accounting for the other capitals.
Yeah, but I mean investing according to integrated thinking, managing the business according to integrated thinking, I mean that's just, as you were saying, a reality check. This is the 21st century. You have more than one financial capital to look after.
But an interesting thing, Leigh, is that integrated thinking has actually happened in a lot of good companies before the IRC was formed. If you look at Novo Nordisk, for example, and other companies, they adopted integrated thinking because they realized to think of the financial in a silo and just do a financial report. Well, investment analysis showed that between 70 and 80% of market cap was not represented by additives in a balance sheet. So what was it? And then you had sustainability report developing. But a financial report, although critical, on its own is not sufficient. Sustainability report, although critical, on its own is not sufficient. So it becomes clear you need to see what is the impact of the financial on the non-financial and vice versa. And eventually one starts even asking, is there such a thing as non-financial?
Yeah. Because
the social and all those other capitals impact on the bottom line. You could have a company making 100 million rand before tax, but the way it makes its money is having such a negative impact on society and the environment, it's actually destroying value. Now, do you want to invest in such a company long term? The answer is no.
And that's why your integrated report needs to be a connected report and not just a combined report. Thank you so much.
Okay.
And thank you so much for watching. We'll see you next week on Doing Business in the 21st Century.
Now is the time for change. Doing Business in the 21st Century was proudly brought to you by Nkonki, the external and internal audit assurance providers. Log on to Nkonki.com to find